What's up, guys? This is Migs from Market Open. I wanted to do a little educational video today on short selling. What is short selling? What is shorting? How do you do it? How do you execute it? And some of the terms that are involved with it today. So as I always start off with these educational videos, I like to give you guys the exact definition of what it is. So I go over to good old Investopedia here. What is short selling? So short selling is a sale of a security that is not owned by the seller or the seller has borrowed. So a short selling is motivated by the belief that the security price will decline, enabling it to be bought back at a lower price to make a profit. So short selling may be prompted by speculation or by the desire to hedge the downside risk of a long position in the same security or a related one. Since the risk of a loss on a short sale is theoretically infinite, short selling should only be done by experienced traders who are familiar with the risk. And I'll cover that here shortly. So now, one of the best explanations I've ever heard for just a simple short selling and how it works is it was actually done with an iPhone. So I'll explain that to you guys. So let's just say that you have a friend that stood in line and bought the new iPhone, right? So this is your friend, and he bought 2 iPhones. Let's just say the new iPhone X. So he has 2, and you really think, or maybe you have some insider information, and you think that the price of this new iPhone X is going to go down. So in this instance, you are, let's make you be red. You'll be over here. All right, so this is you. And so what ends up happening is you ask your buddy, hey, let me borrow this iPhone and I'll give it right back to you. So what ends up happening is your friend borrows you one of the iPhones, and you immediately turn around and sell the iPhone. Let's just say that he paid $1,000 per iPhone. Well, this is some really ugly zeros, but so you'll immediately turn around and sell the iPhone to somebody else that was not fortunate enough to get any of the iPhones. So you'll turn around and sell it for $1,000 to some poor sucker that maybe had work, hanging out with his friends, maybe just being lazy, whatever. So you sell the iPhone immediately to him for $1,000. So now you don't have an iPhone, you only have $1,000. So now you still owe your friend an iPhone. So what you do with those $1,000 is the price of the phone goes down to $700. So now what you do is you end up buying the phone for $700, and the phone right here. You end up buying the phone for $700, comes right back to you, and then you turn around and just give it back to your friend. So now you just profited $300 just from that sale because you knew that the price was going to be lower. So you just made $300 on just a short position. That's basically all you're doing is just shorting. So now let me give you a real life example. So now CELG had some bad news a couple days ago. I believe Thursday. Yeah, so Thursday they had really bad earnings, right? And I knew that the stock was going to sell off. I knew that the price was going to be lower. Now, the example is right here. So on Friday, I was looking for a continuation play. This is something that I look for a lot of the times. This is called a VWAP rejection pattern. So regardless of that, I knew that the price was going to be lower. So when you short something, you must short sell it to somebody that is willing to buy it at that price. So you must sell it to somebody on the bid. So now if we go back to this, your friend with the iPhone is the broker. That is who is borrowing you the shares at no cost. So he's borrowing you the iPhone. So your friend is the broker, this is you, and this person right here is the person sitting on the bid. So this is the person that is willing to pay $1,000 for that iPhone. But in this case, that person is sitting right here, willing to pay, let's just say, $97.50. So if you see that this person is willing to pay $97.50, you short it. So that means you automatically borrow the shares from your broker and you sell it to this guy. Now you are short, let's just say 100 shares. So now what you have to do is you sell first, which is going short, and then when you cover, you have to buy back those shares so then you can turn around and give them back to your broker, which you must do on the ask. So now, let's just say that you go short here at 97.50. The price, just like you were thinking, keeps going down. And let's just say that you cover down here at 96 even. So then what you do is all you do is just hit 100, and then all you do is hit buy. So then you'll cover right at 96, and then you just profit it. It'll say CELG plus $150. So you just profited $150 by going short and being right on that trade. Okay, now the next thing that I want to cover is what if it goes the opposite way? So now let's just say that instead of the phone price going down, the phone prices actually went up. So instead of $700, the price actually goes up to $1,200. Now, you still owe your friend the iPhone. So now, unfortunately, the price went up and you were wrong, and now you have to turn around and buy the phone for $1,200 instead of $700. So back here, and then unfortunately, you are now down $200. So now let's just give you a real life situation. So now let's just go to Amazon. AMZN. There we go. Okay, so let's just say that you wanted to go short on Amazon here. So you're thinking, okay, well, once it breaks, let's just use a whole number here, for example. Let's just say once it breaks 150, 156, I think I'm going to go short. So you just type in Amazon, AMZN, let's just say that you buy 10 shares, whatever. 156, and then it ends up going your way at the beginning, so it goes down all the way down to 1050, but then all of a sudden it starts going against you, and you actually stop out up here at the high of day, or 1060. You realize that it's not going your way, so you cut out. So unfortunately, you shorted here at 1056, and it starts going your way. Now, since you were wrong, you're going to have to pay a higher and higher price. Now, this is a good example of what Investopedia was saying earlier, is that, let's see here. Short selling may be permanent speculation. Oh, since the risk of a loss on a short sale is theoretically infinite, short selling should only be done by experienced traders. So now what they mean by that is that technically numbers are infinite, so the price can keep going higher and higher and higher. So technically Amazon could go to $2,000 today, $3,000, it doesn't matter, but you still have to cover your position. You still owe the broker those 10 shares that you borrowed. So if the price goes to $3,000 in, within an hour, you still have to cover those shares. So now you have to buy back those 10 shares at $3,000 a piece. So even if it goes to $5 million, you still have to cover those. So that's what they mean by short selling has an unlimited amount of risk. Unlike buying low and selling high, which is called going long, a stock can go to zero and then you lose everything that you've put into it. But if you go into short selling and you don't know what you're doing, you can pay a lot higher price because now the stock can keep going higher and higher and higher and you still have to cover your short. And now you can actually go into debt into the broker. So if Amazon actually goes to, 2000 today or this day that it went up, you would still have to cover your short. So you're losing all the money that you paid and then some. So that's why it's recommended for you to know what you're doing before you start short selling because it can be very dangerous. Alright guys, thanks for watching this video. If you have any questions, make sure to leave them down in the comment section below. And also make sure to like and subscribe this video and look out for any new content that I'll be putting out. Alright guys, I'll talk to you next time.